Okay, good afternoon, everybody. Because we're running so late, I'd like to start the meeting as quick as we can get going here, please. And are there any public comments, Doug?
No, sir. There are no public speakers today.
Okay, good. Then the first order of business, excuse me, is approval of our minutes of our September 26th Finance Committee meeting. May I have a motion, please? A second, please. All in favor? Okay, Doug, the work plan, please.
No changes to the work plan.
I'm sorry, wait.
May I, Mr. Chairman, I didn't receive the board materials till noon today, which is an unfortunate set of circumstances, and none of which were my fault. But so I've tracked down the problem at MTA, and they've pledged not to let it happen again. But the unfortunate thing is I will only be able to abstain on all matters today because I was not given anything close to a reasonable amount of time to review the materials for today's committee meeting. So I will be abstaining. I will be here to ask questions and to try and participate to the extent possible, and I realize it's not the chair's fault, but I did have to let you know why I will be abstaining.
Okay, Doug, you made a note of that, please?
Yes.
Okay, thank you. Okay, and the work plan?
There are no changes in the work plan.
Okay, great. Then go ahead with Budget Watch.
Sure. We've had some pretty good results this month and in the months since the mid-year forecast. Overall we've been tracking very favorably. I'll start with passenger and toll revenue. Now for the month they were slightly favorable, and year-to-date those are in fact unfavorable by about $25 million. However, all of that reduction was the result of the Tropical Storm Irene losses in August. Were it not for that, we would have been slightly favorable in that category. Moving to expenses, operating expenses were on target for the month, but year-to-date they're $107 million, or 1.6% favorable. Now, while timing has played a role in this, there's also been some real expense savings, and some of those savings will be captured in the November financial plan, which you will see next month. And we're favorable in spite of additional costs that were associated with Irene, including $19 million in unfavorable overtime costs. We have sort of some unofficial estimates on the impact of Tropical Storm Irene. We think that they're about $50 million on the operating side. And at the commuter committee today, Howard Permit, the Metro-North president, announced that the capital reconstruction costs, including busing, would be in the range of $30 to $40 million, which is considerably less than the $60 million projections we were looking at not too long ago. So that's pretty good news. Again, all of those costs, operating and capital, we'll be hoping to recover as much as possible through insurance and FEMA. Continuing with expenses, debt service costs year-to-date were $23 million, or 1.5% favorable. Some of that is due to timing, and some of that is due to favorable variable rates that we continue to see. I'm going to move to subsidies now, if no one has a question on revenues or expenses. The new state aid, including the PMT, continues to come in remarkably close to budget. We really seem to be hitting that pretty accurately. TOA taxes are on target. PBT taxes were slightly favorable, but that's timing. So all of those taxes really are coming in right on budget. Some good news is,
what's the annual value of PMT?
well, it's about 1.4 billion. Yeah. Yeah. It was 1.3 in 2010.
It was originally planned to be 1.7.
Yeah. Hopefully at one point we'll get to 1.7. We keep growing.
More people. You got to create jobs, Doug, and then you'll get it.
I'll give it my best shot. Moving to real estate taxes, if you recall last month we had a very strong month. And this month was strong, but nowhere near as strong. Let's see. We had $45 million in taxes for the month, which was $5 million, or 11.9% favorable. Year-to-date total real estate taxes have been favorable by $54 million, or 11.8%. Again, a lot of that was from last month. Since May, total real estate tax receipts since the mid-year forecast have been better than expected, primarily because of the unexpectedly large revenue from urban taxes seen in the past 3 months. The urban tax has been responsible for 90% of that favorable year-to-date variance. So again, we were $54 million favorable year-to-date in real estate taxes.
Right, but you have to have, there's a word of caution there. If you take a look at the urban tax, if you look at what happened in October, you'll notice that for the first time we had a really big fall off in the urban tax in October. As a matter of fact, it went back to levels, as Bob said, back to May. It's the lowest level since May, and I hope that it's not indicative. We'll have to watch this very closely, because what I think happened is when all the commotion started in July and August with in the financial markets, we were living off deals that had been done prior to that, early in the spring, that were then closing, so the tax was recorded, in the ensuing months. But now I think you're living on the real world, and we have to see that things didn't freeze up after all the commotion that happened in Europe and here. So this is going to have to be watched very carefully. But if you look, we've come way down. We were running, for example, $47 million in July, $33 million in August, $52 million in September, and now we back down to $25 million in October, which was not that much more than where we were running in May. So we have to watch this very carefully.
Okay. Those are all very good points. So, as I said, we've been doing better than the mid-year forecast. Again, revenues is the only area that we are down. We've been favorable in expenses, debt service, new state aid at PBT basically on target, and real estate considerably favorable. So, overall, it's been good news, and we're looking at these results and anticipating how they will come into play when we redo the 2011 forecast in November, and whether any of these trends move forward into 2012 and beyond.
That was going to be my question, Mr. Chairman, if I could ask. Obviously, many of us are hopeful that a number of the service cutbacks that were incorporated into the 2011 budget could be changed and restored for the 2012 budget. We had that conversation today at the commuter rail meeting. I know Andrew had it at the transit and bus meeting. The question I raise is, when will we know what our 2011s will be going into 2012 so that the board can make those kind of informed decisions? Will we have that information available upon whatever we're going to do for the 2012 budget in December?
When we present the November plan, we'll be giving you the forecast on what we think revenues will be through 2012. We'll talk about expenses as we see them coming, both the macro expenses, the large cross-agency, as well as each individual agencies. We're gathering that information now. So I think between November, December, at which time you would adopt the budget, you'll have information to consider.
Okay, and could we also ask, if you could ask the agencies as part of that discussion to give us some idea, either on an individual or collective basis, on what the restoration of various services would cost, so that we can prioritize that within the confines of what we want to do for 2012?
Yeah, sure. Well, I guess
and they should prioritize them also, obviously,
Yeah.
because if we find we have, I'll pick a number, $10 million. I'm just picking a number that we could restore certain services for. What would they consider to be the most important ones to restore in that regard by agency? Because I think that would be important for the board to know that.
But you know what, Mitch? I think with what's going on here right now, we are in a completely uncertain time. We don't know what's going to happen with Europe, the effects of Europe. I mean, all the things, you read the same as I do.
understand, yeah.
The newspapers. And I think that we have to be very, very careful, because the budget is so precarious, that we continue on the plan that we had to make every single dollar count. every expense dollar, every
Yep.
capital construction dollar, because we really don't know what's going to happen. I mean, just look at the layoffs that are hopefully not coming, but I think are coming in Wall Street, the diminution of the bonuses that are coming. I mean, we all read the same papers.
We read the same
there.
papers, yes.
So I think we could be headed for a really serious, and you see it right here in the real estate tax. That's why I brought that up
Yep.
in 1 month. So right now, we've got to be very careful that we don't commit to any things that we can't, in my opinion, I mean, this is the board's decision,
Right.
obviously, but we got to be very careful that we're very conservative. And we
Well,
stand.
I think I understand that. However, taking the other side of that, if you know, for those of us who have sat through now 5 customer surveys, presentations starting at 8:30 this morning, there clearly is a feeling that in certain circumstances there are things we should be able to do to relieve some of those consumer expectations. Not only expectations, but the negative issues that have occurred as a result of that, whether it's standees, whether it's additional service, whatever it happens to be. So I think we have to look at how we play that in the context of everything that's going on. I'm not saying we do it, but I think what we need is to have the information to be able to make an informed decision when we get to that point.
And just to buttress what Commissioner Pally is saying, where Mitch is coming from and the other commuter railroads, to see this hated, PMT and to have gotten less service for it just doesn't sit very well with a lot of customers. So I understand where Mitch is coming from, and I think, we certainly share it in the city as well.
And it doesn't just apply to commuter rails.
No, it applies to everything in that regard. But as I said, the information is necessary to have so we can make an informed decision.
I understand.
Well, one other caution is we're waiting on some revised state revenue forecasts that should be forthcoming in the next week or two.
Okay.
So that's a very important variable that will be coming in.
Well, you indicated we would have more information in November, and then between November and December we can make those determinations. That's fine.
Chuck, you may be aided if you bifurcate the cost issue in terms of saying, what would you want back by restoration if it could be achieved in the second half of the year? In other words, providing you a deferral during the first half. You might find that more palatable from Bob's perspective.
Okay, to be continued. Oh, I'm sorry.
Thank you. Not to pick nits with my fellow board members, but it seems to me that the initial job of picking winners and losers in an area like this should fall to the staff. It is their job as well to restore service to the extent that it's feasible and that fiscally and otherwise, and that maybe a better approach would be for those service restorations that can or should, they believe, should be instituted, that they show up in the budget, but that a list of those that were not that were not chosen be supplied to the board, rather than having this kind of a free-for-all here at whichever meetings we're talking about.
The assumption there would be that any are showing up in the budget. And I think that's the question at the moment is, are we anticipating any additional service or restoration of any service reductions in the 2012 budget? I think that's the first question, Jim, because you can't get to the second question until you get past the first question. If the answer is no, then I think it's incumbent upon the board to look at that. The answer is yes, then I agree. We have to see what is being restored or what is being proposed to be restored, and then determine whether those are a higher priority than other things. I agree with you in that context, but only if any are being proposed to be restored in 2012.
I just want to be very careful, though, that we don't send off wrong signals out there that we're going to start restoring service, because that's how it's going to be picked up. And I think that we have to look at the revenue side of this thing, and we're on a path. We've established a path that we were going to we're going to go to. We went through it the last 2 years. And I think that we have to look at that and make sure we stay on it. If there is going to be revenue successes, and it would seem to me that that would be the first thing we want to reestablish, are the service cuts. But I think is right now, we want to make sure that we stay on course. And maybe we'll get some good, maybe we'll have some good luck. But I just don't want to send off wrong signals that we're going to start restoring.
As I said, let's see what happens in the next couple of months. We're going to get much more clarity, I think, in the next couple of months as to how everything evolves. There's a lot of questions out there. So let's see where we go. Right now, we don't have to do anything. We're on a solid course, I think, that's been set. I agree with Jim. We need to stay on that course. And we will look at it when we get the proper information from the finance team at the November Finance Committee meeting.
Good. Thank you, Mr. Chairman.
Okay.
Yeah, that's it for Budget Watch.
Pat,
Next will be
Finance Watch?
Finance Watch.
Thank you. Finance Watch appears in the committee book on page Roman numeral 4-1. We have one transaction that was completed since our last meeting. This is the TBTA 2011 Series A. This was an economic refunding of existing TBTA bonds. The total transaction was $609 million, and this was emailed to all board members after the transaction priced. This is a very good story. The refunding generated a total of $116.8 million nominal or gross savings, or $86.8 million of present value savings. This was nearly 12.8% of the refunded bonds. So a very positive transaction. Next year, this will generate $2 million of savings for TBTA, growing to $6.1 million in 2013 through 2017, $4 million in 2018 through 2024, and then in the final years of 2025 through 2028, the transaction results in $14 million annually in savings. We caught a very good time in the market to bring this, and we're pleased with the results that we were able to achieve with Morgan Stanley, who was the book running manager on the transaction. So, any questions about that? Okay. The remainder of the Finance Watch is included in the book. I'm not going to go through that, but it's there for your information, and if there's any questions, I'm happy to take those after.
Pat, hi.
Sure.
12.8% you said savings? That's
Of the
quite sizable.
refunded bonds, that's right.
Right, okay. Which is the customary way we refer to that. So, and what is the standard you generally bring to the board or try and do?
Well, the board policy on,
Right.
on refunding is we try to achieve on we have a matrix for each for the various maturities and years to the call, years to maturity, very similar to the way the state does it. But on an overall transaction basis, we seek to achieve 3% savings. So we obviously
well exceeded
the board policy.
Are there others? I hope, again, I hope we can, anything that's eligible to refinance given the low interest rate environment before it unexpectedly changes, I hope you're pursuing, and I look forward to it. But I have a question on the responsibility of the board members, and maybe we can ask council to report back on this. But at the scintillating recent NABL conference, National Association of Bond Lawyers, one of the panels went over the responsibilities of board members, including elected officials and appointed officials, to actually read and be responsible for reviewing the preliminary and final official statements for bond offerings. This is based in part upon the SEC's pronouncements in San Diego, New Jersey, Orange County, and some recent pronouncements that were included in some dictum of the SEC. But nonetheless, a lot of the practitioners are advising their clients on this issue. So I would like to know what the standard that our council is deeming us to be held as board members who are responsible for reviewing the various offering statements for our financings. And if you don't know right now, I understand, so we can just get back to me.
We'll be happy to speak further.
No, thank you.
Outside town council and get back.
Thank you. Thank you.
Okay, thank you. That concludes Finance Watch.
The next thing on the agenda is termination of leverage leases. Doug, you want to take us through that, or who's going to do that?
Let me run through this quickly, kind of in as simple as I can.
Lots
Jerry
of luck.
Page is here. Jerry Page is here to give greater details. We have a number of lease transactions that we've done at the MTA through the years, and the aspect of this is the MTA has capital assets that it cannot avail itself of depreciation or other tax benefits. And we put the transactions together, and then basically we enter into a transaction with a counterparty who can use the tax benefits. They turn around and give us cash up front that we have been using for our capital program. To do this according to the IRS rules and Treasury rules and regulations, we're effectively putting monies aside, both debt and equity, that would prepay or defease the rent streams that we have to these lessors for the properties, and also at the very end give us monies to exercise a purchase option for those for that asset. In January of 1997, we entered into a leveraged lease or a lease transaction for the Hillside property. It had a value of about $313 million. We received about $22.7 million for this. At the same time, we did set aside both kind of a debt component and an equity component to fulfill our rental obligations and also to pay for this purchase obligation when it became due in 2019. The equity component was funded with U.S. Treasury zero coupon obligations. Now, again, you can imagine since 1997, interest rates have fallen dramatically during that time, and those U.S. Treasury zeros are worth a lot more than they were at that time. Now, this is money that is not ours. This is money that has been set aside, and it's only available to the lessor at the end of the transaction. The lessor has approached us and asked if we would terminate this lease transaction early, 7 years before its final maturity. In doing that, we would give them the U.S. Treasuries at this greater than, original value, so at the higher market value. The benefit to us is this is a transaction that, again, we receive something up front, and thereafter there's only risk really for us. If there's a casualty problem out at the property, we're liable for fixing it, and there may be damages that we have to pay as well. We are going to have to pay legal expenses at the end of this lease to unwind it. We always knew we would. So to terminate it early, we can avoid certain risk inherent in leaving the transaction out there. We still have the benefit of the cash we received up front, and it'll probably cost us about $50,000 of legal expenses. So as we look at it, this looks like a good transaction. We've already received our benefit. It's not costing us anything other than the legal expenses that we would otherwise pay in 2019 anyway, and we can avoid risk. Jerry, is that?
Wouldn't we, if it, I don't mean to jump in. Thank you. As far as the benefits are concerned, Bob, if there was a casualty at the site and it were not leased, would we not have to fix it anyway?
Jerry,
I mean, the answer to that is yes, but if you had a casualty that was catastrophic, we might not want to replace it in kind. We might have to, it might not meet the substitution requirements from the IRS, and therefore we'd have an early termination, which has a penalty value associated with it. So there is a benefit to eliminating any risk of a casualty that could, that would somehow constrain our flexibility to do a rebuild.
But it's a bit of a reach, I would say.
Sure, but we've run into it on with subway car leases where we've had casualties. Obviously, there,
those guys roll. Yes, exactly.
Yeah, right. But
is the am I understanding then that the lessor is going to get the benefit of these now premium priced zeros?
That's correct.
And how much is he going to get?
it's $82 million, I think, at the current market value.
I'm sorry. It's
$82 million higher than face.
No, I think their face value is 82.
No. Yes, but
what's the gain?
Well, it's a zero coupon, so they're ultimately going to get the face value at the maturity in 2019.
Well, unless they sell them today and do something else with the
Well,
money.
they're going to do that.
Right.
Well, exactly. What's that
Correct.
worth to them?
Worth in the sense
Well, how
of...
much can they sell them for today?
They can sell them for $82 million, and the accrued value, I'm not sure we looked at. I mean, it's something like $60 million. So they're-
$22 million
something
excess
like
here?
that. I believe so, yes.
And you're settling on this because you're getting out of a risk that might possibly happen?
No, we have no
Mark.
option.
You do have an option. You can refuse to do this transaction.
Well, Mark,
Yes.
I guess the question for it, if we refuse to do the transaction today, there's no economic benefit to us in doing
I
that.
understand that, but
And-
there's a significant economic benefit to them. I assume it's their initiative which has brought this transaction forward. And why aren't they giving you a larger participation in the benefit? Did you ask
Yes,
Yes.
we
for a
did.
benefit?
Yes.
And we talked to a number of people who have been doing terminations in this marketplace, and whether it's actually very unusual for a lessee to be able to early terminate a transaction without coming out of pocket.
You are, I mean, as I understand it, they're not even paying you the $50,000 in legal bills.
They're paying us 25 of the 50, and we expect that we'll cover.
Guys, I mean, just, I think you're being had.
I mean, that's fine. We can not do the termination,
Right.
then we'll play the...
You can not do the termination on these terms and say you'd be happy to listen to them, but you need something that shares some of the benefit with us.
We did that.
Well, do it again, because
Okay.
quite honestly, as soon as you've done the transaction, you've just given it away. I don't think that Treasury rates are likely to go up in the next 10 minutes. I could be dead wrong, but that's certainly not the general expectation. You have considerable time here.
No, we can
It is a
certainly go
wasting
back to them.
asset, but it's a wasting asset for them.
That's true. And we went through a negotiation process, and we can say that our board disapproved it, and they may come back to us, and they may just say, okay, we'll wait until 2019, and the deal will have a purchase option, and if there's a casualty or in the interim, we'll have that exposure.
Move to reject the transaction.
I would second. Anybody else want to speak on this thing? Then there's a motion made. There's a motion made. All in favor?
Aye.
Opposed? It's finished.
Okay.
It's over.
I would actually say that I doubt very much that it's over, and would be happy to entertain another version of the transaction should that by chance transpire.
Well, when I said over, I didn't mean that the deal, I meant that this was over. Let me clarify myself.
Thank you.
Okay, to be continued then. How's that, Mark? Is that better? There you go. All right. Okay, next item on the agenda.
Next, we have two report and information items: the annual review of MTA's derivative portfolio and the MTA 2011 semi-annual investment report.
Okay, so derivative, Pat, you're going to do that, right?
Yes, thank you. Everybody should have this packet that was distributed this morning. This is just an information item. In the work plan, we address the portfolio of derivatives each October at Finance Committee. So turning to the first page, our derivative program consists of two types of hedges: interest rate hedges, which protect against potential of rising interest rates to achieve a lower net cost of borrowing or to reduce exposure to changing interest rates or to achieve debt service savings; and lastly, fuel hedges, to establish more certainty and stability in budgeting the future price of commodities used by MTA. And here we're speaking strictly about ultra-low sulfur diesel and natural gas for the revenue fleet, but both buses and diesel-powered locomotives on each of the railroads. And so turning to the next page, here you see our total debt structure represented by its various products that are in the market. And we're speaking today about the red slice, the hedged variable rate or synthetic fixed rate bonds of $3 billion. As you can see, the bulk of the portfolio does remain in fixed rate mode at just under 80%. The remaining colored slices up at the top just represent what we would characterize as unhedged or natural variable rate debt, either in daily, weekly mode, commercial paper, or mandatory tender bonds. The mandatory tender bonds are typically couponed, carry a fixed type coupon, and I'm going to talk about that later, and that's about 10.4%. Turning to the next page, the portfolio of interest rate swaps, again, we speak to that $3 billion part of the portfolio, which is in synthetic fixed rate mode, achieved through these swaps. This product has proven to be a cost-effective source of capital, costing less than fixed rate bonds at the time of issue. We limit our risk associated with these swaps by adhering to ratings and diversification standards contained in the board-approved swap policy, and that policy is attached to your packet for your review later. We have a total of 17 transactions outstanding, 15 of which meet the GASB 53 rule for accounting treatment as effective hedges. It begs the question, what about the others? There's two transactions that we deal with here. The two Broadway cops, which, as you know, are in auction rate mode, failing, and we're addressing that right now, as well as a portion of a basis swap that is what we would call orphaned. They're not associated with a particular set of bonds. That represents the remaining swaps that don't meet the GASB 53 rule. Turning to the next page, over the past 12 months since this report was last given, our portfolio has, we've paid an average rate of 3.85% in fixed rate. And obviously there are two variable rate components to this. One is the variable rate that the MTA receives from the counterparty, and secondly is the variable rate that the MTA pays on those hedged variable rate bonds. And you see the difference here of approximately $9.6 million difference between the variable rates paid versus those received. This is really offset by the estimated savings of approximately $19.6 million that the MTA locked in, if you will, relative to the cost of fixed rate bonds at the time of issue.
An annual.
And that's an annual. Thank you. That's an annual number. The shortfall that we see here, what we would call basis risk, is caused by really two dynamics. One is we've got some hedged bonds that are supported by Dexia, which is a bank that's under some stress in the European situation, and we are working right now to replace Dexia on a number of bond programs, and we'll obviously be reporting on that when we get the results in, but we're looking to deal with that. And lastly, the certificates of participation for 2 Broadway. Again, the board approved, and we are undergoing an invitation to tender those bonds and deal with that risk as well. Turning to the next page, our derivative contracts by credit are listed out here.
Pat.
Yes, Jim.
I don't mean to anticipate your report on Dexia.
Sure.
But in a sentence or two, can you describe how you get out of a box like that?
Well, sure. The transactions that we're speaking about are 3 of them are on the TBTA credit, general revenue credit, and for approximately $550 million, and we've got 1 transaction on the DTF credit for about $440 million. The way we get out of that is we've gone to the universe of banks, both domestic and international, that are active in the market and providing liquidity to municipal issuers like the MTA. We've asked them to, we've laid out our transactions where Dexia is on the transaction. We've asked them to come back to us with pricing for that institution to step into the shoes of Dexia, and we would effectively replace Dexia. I don't think the story ends there, because the reality is that there are other alternatives we have other than putting banks in. We can, and as we've successfully done earlier in the year, we can issue notes that are tied to the SIFMA index that float with that index, and it would keep those swaps viable and integrated in the market. So I think the first step for us is to get the responses back from the banks and see where the costs are, and then evaluate those with our financial advisor relative to where we might put out an FRN product, and then we'd engage in actually doing those replacements, one way or the other. Or the last thing you could do is you could leave the Dexia programs in place. Clearly, that's not where we're thinking that we need to be, given the fact that the bank itself is under a lot of stress. It's going through what we would call a breakup and reorganization now. We're not quite sure how that shakes out in the future, whether that might be a good thing or a bad thing. So the solicitation, it kind of came, we put that out about the same time that we heard about the breakup. So we've got a lot of moving parts that we're trying to sort through here, and we'll continue to keep
order of magnitude on the cost to the MTA if you do make a change like this?
Dexia was probably the most active bank in the muni market over the past, call it 12 years or so, and many of those facilities that we're talking about are very inexpensive to the MTA in terms of the actual letter of credit. What we're making up for, though, is in rate. We're paying a higher rate on the bonds for investors to take the bonds. To be direct with you, we might be looking at a cost of 15 to 20 basis points now, and a cost of a new bank coming in. I would, again, until we see the results, we don't know, but somewhere in the 50 to 80 basis point range.
Jim, so again, what's happening is just the cost of a facility when Dexia entered into these transactions across the board were much less expensive than they are today. So anytime we replace anyone, we're spending more money. The concern we have is these Dexia transactions are being priced at many, many multiples of LIBOR in certain cases, 250, 275% of LIBOR. Right now, 1 month LIBOR is pretty inexpensive, so we're still not paying a huge amount relative to fixed rate bonds. The concern we have is if interest rates do start to rise with that multiple on it, this could become expensive very quickly. So we do have a strategy of really trying to start bringing it down, just as we are with our auction rate securities too. But across the board, we're going to spend more money if we have to replace a bank facility that was in place years ago. Thank you.
And to give you a sense of where those bonds have been repricing in the market, I would just turn your attention to Roman numeral 4-4 in your committee book, where we lay out the trailing 6-week resets for all the variable rate bonds. And if you look at the second row, the dedicated tax fund row, the DTF 2002B transaction, you can see those rates have reset from anywhere from 2.25% to most recently 2%. And you can evaluate that next to the other facilities where we've got other banks, and you see that the Dexia facilities, those bonds are costing us money to place them with investors. Okay. So I'm on page 5 here, where we lay out the derivatives, the interest rate derivatives by credit. I'm not going to go through this, but just the concern that we've talked about in the past is the mark-to-market. A couple of comments on that. The mark-to-market value represents what I would call a theoretical replacement cost of the transaction. The transactions themselves are working, and we're not interested in terminating or doing anything with them other than to keep the bonds related to them working well in the market. The swap portfolio is performing as expected. The reason that mark-to-market is so high, negative to the MTA, is because interest rates are very low. We're taking advantage of that when we enter the market. The TBTA refunding transaction that I spoke about speaks to the low rate environment that we are in. Sure.
Mark to market, is the mark the value of the product, is what you paid for?
The way to think about the mark-to-market is if there was some event that occurred today, what is the unwind cost to that transaction? And we would be a net payer. We would have to pay out to terminate that transaction.
It's basically what it would cost to duplicate the obligation that exists between you and this counterparty with somebody else in the market today.
Okay, but what is the mark, the actual value that you paid for it?
No, it's literally, it's an active market. There are people providing this kind of obligation in the market. How much would they charge you for it?
Okay.
And you actually can go out and figure that out.
Right. Thank you. Again, thus far, MTA has not been required to post collateral on any of our outstanding swaps, and there's a limited P&L impact to the MTA, as 15 of the 17 transactions are what we would call effective hedge swaps in accordance with GASB 53. Turning to the next page, we see here our 8 different counterparties where we've entered into swap transactions, their ratings, the notional amount of transactions with that entity, the percent of the portfolio it represents, and the current mark-to-market. Turning to the next page, we want to discuss quickly the fuel hedge program. We've been hedging a portion of fuel costs since 2008 to provide budgetary certainty in the fuel expense category. As I spoke about earlier, we're talking about the revenue fleet, and we're talking about ultra-low sulfur diesel and natural gas. Those are the only 2 products we're talking about. In December of 2010, the board approved a $100 million fuel hedge program for the 11 to 12 years, and that represents about 40% of our revenue fleet fuel requirements. To give you a sense of the July plan, there's a forecast there of $248 million for these 2 fuel types in the budget. And we use a competitive method of sale to when we engage in the trades, and our current counterparties that we work with are Bank of America Merrill Lynch, Deutsche Bank, and Goldman Sachs through its wholly owned subsidiary J. Aron and Company. The way we've done these transactions is that they're structured as laddered 12-month strips that catch settle on a monthly basis, and the hedging capacity that's freed up allows us to look at laying on new trades down the road. There's no physical exchange of fuel. This is a financial contract. We have six transactions outstanding, again, all of which meet GASB 53 rule as treatment for effective hedges. And turning to the next page, this gives you a sense of what the current picture looks like. As you can see on the lower left here, the dashed lines represent the budgeted price in November, and then stepping up slightly to the 234. Again, this is all ultra-low sulfur diesel that we're looking at right here. Those represent the market conditions really back in August, September, when the plan was being put together. And then we came to the board, sought authorization, and what happened in the meantime was the market really got away from us, and we began to enter into these transactions denoted by the colored lines here. We weren't sure, and we're still not sure, what happens with the commodity on a going forward basis, but the objective here was to provide budgetary certainty for a part of that fuel need, recognizing that a significant part of it comes at the cost of what we would call the spot market. The interesting thing here is if you look at the top dashed line, that represents our budgeted price for ultra-low sulfur diesel in the July financial plan. So depending on how you look at it, you're either locking in a loss or, in effect, we're locking in savings relative to the budget, taking out some of that volatility that exists in the commodities market. And I just draw your attention to the box on the upper right on natural gas. Again, budgeted at $4.56 per MMBTU, currently hedged at $4.24. And there's one trade on there. Natural gas is the smaller, obviously, of the 2 components. Of the $250 million, only about $25 million is budgeted for natural gas.
So Pat, looking at that chart, we didn't do so well on the
Yeah.
on the sulfur, on the low sulfur.
Now, let me kind of discuss this. The way we're doing it right now is something that I'm dissatisfied with. If we have to come to the board every year to get permission from the board to enter into trades, by the time we get the permission to enter into those trades, as we saw here, in the fall, prices went up. So during that fall, while we're still waiting to get our budget approved, because we did not have the trade, the hedge in the budget, because we were cash constrained, we fell behind. Then as soon as the Arab Spring hit January 1, they took off again. To me, if you're going to enter into a fuel hedging, what you're supposed to be doing is roughly like every month, enter into, for a portion of your hedge, a 12-month, forward laddered approach. So you're constantly in the market. It means that sometimes you're going to be saving money relative to your budget because the budget does change. At other times, you're going to be above what you have in the budget. But the whole point of this isn't make money, lose money. The whole point is to have certainty to your budget so that you're not going to get whiplashed by these costs and then to reflect these costs into your budget projections. So to me, you can clearly see that the market changed dramatically. Not putting on the hedges when we put the hedge meant that we would have been well above that in terms of our costs, so we did, quote, reduce our exposure. But you weren't able to move when you should have moved. And I think we're going to come back to the board, hopefully in November, and say, look, here's what we would really like to do. If the MTA is going to be engaged in a hedging program, we ought to be engaged in a hedging program on an ongoing, regular basis, as opposed to coming back and saying, we need permission this year. Can you give us permission? Not saying approval is not what we're seeking, but we don't want to wait for the budget to determine when we can put a hedge on and when we can't. And if it makes sense for us to hedge 50% of our exposure, we ought to be constantly in the market with something that locks in prices for at least a 12-month period so that we know what we have, at least for a portion of it. And I think that's what we'd like to present to you, is something that's a little bit more regular, recurring, and static. Otherwise, right here, again, you can see the benefit that we're receiving versus the current budget, but I'm just not comfortable that that's the smartest and best way of doing anything. It just seems a bit to me not haphazard, but we're having to make calls, and I would just rather say if you're going to be hedging, decide how much you want to hedge, and then just do it on a regular basis.
See, I just one second, Mark. I think if you remember when we approved this thing, nobody was really happy with it. As a matter of fact, I think it took a couple of meetings for us to do it. First time we sent everybody back. Wasn't that what happened with the thing? And then nobody was really happy. So Bob, in this pre-meeting that we have, suggested something like this. And I said, I think this is something you should at least bring out to the board and let everybody think about it. Because for me, either you hedge the thing properly and do it on an ongoing, like Bob says, or don't hedge it if that's what we decide to do it. Take your risk in the market. But this thing is almost like market timing, which is just crazy. And I don't think you really come out as a winner here. So I think it's something we should all think about. And I asked Bob to just throw it open to the board, and everybody should think about it. And Bob, next month you want to talk about it again? When did you feel you...
I would like to talk about it next month.
Talk about it next month. But at least you have some idea here. Mark, go ahead.
I think that, what you're looking at here is that basically to make money on hedging, other than being lucky, which might happen now and then, basically requires that you have a better grip on what's going to happen to the particular, in this case, to fuel prices in the future than the general market has a grip on that issue. And the chances of our being able to do that, I think, are very small. So what you're really talking about here is how much is it worth to you to have certainty over the next year over what all of your fuel cost is going to be, or a portion of it. I think it would be interesting to look at what the budget impact of fuel cost swings have been for the last 4 or 5 years, maybe, and then some thought about our own ability to absorb that kind of swing. I mean, the hedge market, I mean, if you're playing it perfectly and you're just routinely in it, presumably you are going to, on the margin, pay a little bit more than you would pay if you could afford to just ride the risk in the market, because you are buying the assurance that you won't have the major fluctuations. And I think it's a question of how much it would cost us to be in a position to sustain the fluctuations versus how much it costs to stabilize it. And I would imagine that we're going to end up somewhere in the middle, that you don't stabilize all of it, but that you stabilize enough of it so that you reduce the fluctuation you can imagine reasonably likely you might get hit with. I know. And if you're going to do that, it's routinely doing the transaction. It is not playing the market. It's playing the calendar. That literally on some interval
you should be able to model
you do it.
You should be able to model it going back, too, right?
All right, so what we should do, instead of, spending a lot of time on this right now, why don't you do your homework, Bob? You know what has to be done, you and Pat. Come back to us at the November meeting, hopefully, if not the December meeting, and make a presentation of what you think we should do. And meanwhile, we all now know, we've heard the debate here, and then we'll discuss it. But why don't you do it, Mark? Let's lay it out. Just come back with a plan of what you think we should do, and present it to the committee, and then we'll talk about it.
Will do.
Okay?
Will do.
Fair enough?
Yes.
Thank you. Is that okay with everybody? Yeah. Okay. Pat,
Okay. Just turning to the next page, you see the active trades that we have on. This is just presented numerically, what was on the prior page. Again, with the counterparties, the amount hedged, the fixed price paid, the mark-to-market values, the termination showing up on the paper. For some reason, it's not on the screen. I apologize for that, but it is in your paper handout. Turning to the next page, we just show the fuel hedges aggregated by counterparty, the counterparty's ratings, the notional amount that's hedged, and the percent of the portfolio based on the notional. That concludes the presentation on derivatives. Again, the derivative policy is in your packet. There's an additional appendix with each trade, and there's various details laid out. I would just point out that in each financial statement of the MTA, whether it's a quarterly reviewed by the auditors or the annual audited, there's a full discussion of the swap portfolio in there, as well as in our combined continuing disclosure filing. More discussion, more presentation of the transactions, and again, we're happy to address your questions on those anytime.
Okay, next item is the semi-annual investment report.
Yeah, it's an information item included in the book. Our treasurer is here if you have any questions.
And we want the procurement stuff?
Sure. Headquarter procurements. We have 4 headquarter procurements, 3 competitive and 1 ratification, for a grand total of $5,104,750.
A motion, please. A second, please. Any discussion? All in favor? Opposed? So carried.
Great. Next, moving towards the Metro North and Long Island Railroad Committee. We have 2 action items for Metro North. The first is a New Haven Line Connecticut fare increase, which is in Section 6, page 1. And we're asking to obtain MTA Board adoption of a resolution authorizing increases proposed by the Connecticut Department of Transportation in Metro North New Haven Line main line fares for travel to or from Connecticut stations.
A second, please. All in favor? Opposed? So carried.
We have one other action item, North White Plains parking structure, which is on page 19 in section 6, and we're asking to authorize the use of $41.8 million for the creation of structured parking expansion and improvements at North White Plains Station on the Harlem line.
Second? All in favor? Opposed? So carried.
We have 2 competitive procurements for Metro North for a grand total of $6,050,000.
Second, please. All in favor? Opposed? So carried.
Okay, there are 2 procurements for Long Island Railroad. The first one is a non-competitive procurement for sole source services of $5 million. Okay, and the second one is a competitive procurement managed by MTA Capital Construction for
Do you have to take them
We can do
separately?
them. We can do
Is
them.
it okay? I'm
Yeah,
sorry,
it's fine.
it's my fault.
No, it's fine. We can do them together. Second one competitive procurement managed by MTA Capital Construction for $1,242,367.
Okay, a motion, please. A second, please. All in favor? Opposed? So carried.
There are no items for the MTA bus operations. Moving to bridges and tunnels, we have 1 non-competitive procurement for a total of $1 million with the City of New York.
A motion, please. Second, please. All in favor? Opposed? So carried.
Next is New York City Transit. There's 1 competitive procurement totaling $105 million.
Wait,
Sure. Question?
question?
It's more of a comment, Mr. Chair. We talked earlier at Transit Committee about this in general. This isn't the specific police radio issue that you and I actually talked about several years ago. It's something similar, not related, but I just wanted you to be aware that it was something that we talked about earlier and something that still needs to be addressed.
Okay. So you're in favor of
I'm in
this?
favor of this, but I just wanted to point the comment.
Thank you. I appreciate
that we need to
it.
resolve that issue that's been outstanding for several years, and we did have a short conversation about it at committee this morning.
Okay. Thank you.
And
Chuck?
also, on that same point on this one, there was amplification by transit on the question that is the subject of the 5th paragraph from the bottom on page 8-2, namely that they have now been able to enter into various agreements that deal with this questionable issue. So what you have before you is less complete than what we had at transit.
Okay, so a motion, please. Now, Doug, are you aware of this?
I don't know what the language is.
No.
Right.
I think that if I understand the
Jim?
conversation that occurred at Transit, the minutes of the Transit Committee will reflect the updating of the significant adverse information that was
Correct.
reviewed and approved.
So
prior
what?
to it coming to the board.
So what amendment? What procurement should we be? How should it be worded, Jim?
I think the minutes of the Finance Committee can also reflect that before the matter came to the board, there was additional review done and the SAI was waived.
Okay. Doug, you have that?
Yeah.
Okay. So is everybody clear now? Is that satisfactory? Okay, a motion, please. Second, please. All in favor? Opposed? So carried.
Okay, there are no FIMTAC issues. I believe this concludes the finance portion of this meeting.
Okay, thank you. Now,
Jeff's gonna
going
take
to
over
real
with-
estate,
yeah.
Jeff.
Thanks, Andrew. You have 6 action items for your consideration this month, which are the subject of staff summaries that are in the book. And as always, I'll be glad to take questions about any of them. Let me just call out a couple of these in the order they appear. First, small lease with a little mismatched in Grand Central, but I think it's interesting in that it reflects the way that our churn has been working under the conditions mandated by the Public Authorities Law. We've had discussion here in the past about what prerogatives should be afforded to incumbents, and I think the irony here is that Little Mismatch was a very popular store that was displaced by another a former incumbent, Toto, and Little Mismatch has subsequently come back and given a high bid for other space in the Lexington Passage. We're very happy to have them back at north of $300 a foot.
Jeff, can you just tell us whose space they're taking?
Nancy, I'm drawing a blank. Sorry? June. June Penn had moved down the hall, and that was on a fill-in basis. Thanks. There are two lease extensions in effect, or I should say substitutions in kind. As you know, we look very hard at all our leased property and are making every effort where appropriate to discontinue leases. These are, in each case, deemed to be vital to the operations of the respective railroads. One is a warehouse for subways, and the other is effectively a part of Penn Station. It's in the basement of One Penn Plaza, which is privately owned by Vornado. We have been actively investigating opportunities for reduction of, not so much reduction of our footprint at Penn, but shifting around and having greater efficiency. There is some space that may potentially be in play that Amtrak is going to be vacating, and we're negotiating to try to, with many parties, including Vornado and Amtrak, to try to come up with a far superior circulation and back-of-the-house plan at Penn, but that will take some time. And in the meanwhile, this lease was due, and we're glad to be able to, in effect, maintain the status quo and extend this lease without increase in the rent for 3 years. So I request your approval of that item. And finally, there's a competitive procurement for all agencies in effect, which is in my part of the book because it relates directly to real estate. It's to do with our tenant management, which we've been outsourcing for some 15 years or so in the aftermath of a PricewaterhouseCoopers report that recommended that outcome. We, after protracted negotiations, we've come to terms with, after a competition, as I say, we've come to terms with the incumbent Greystone Management. It reflects a significant increase over our current cost, which we're not happy with, but the procurement department did everything possible to pull that price down, and it is significantly less than the competitive bid that we received from Cassidy Turley. So I would ask for your approval of those 6 items, unless there are any questions.
Yeah, as long as there's agreement that everyone's on the same page.
So a motion, please. Second, please. All in favor? Aye. Opposed?
Thanks.
Jeff, do you want to just for a second just make a quick comment on the major project you're working on not a formal update?
Sure. Sure. Well, thank you, Andrew. We talked about this before. We are, as the board knows, we are proceeding to implement the office right-sizing plan that we outlined broadly in April, with refinements as we learn more about the specifics of our opportunities. We engaged with your authorization a team led by Cushman & Wakefield with the Phillips Group as architects to help us with that effort, and we are well into a programming and surveying effort to identify what our space needs are overall and what our opportunities are specifically for consolidating and restacking at 2 Broadway, which is the core of the proposition, based on preliminary information which we are pulling together and hope to have assembled in another month or so. I'm actually optimistic that we have room for more people at 2 Broadway than we had projected, not fewer, which may give us some opportunities to achieve still greater savings in our space lease portfolio. So we're excited about that effort. We think it's going well.
So the important thing is this 3-year plan that we've embarked upon to maximize our resource in the real estate department is way underway. And Jeff tells me our 3-year plan through, what was it, April 14, basically, to work this thing over is on schedule and moving along. And I think you're going to be back to us to report, though, on the suburban properties, Jeff. You said the third part of this in the near future?
Yes, that's right. We talked last time about the city portfolio, and we promised to come back with the suburban portfolio, and I expect we'll do that probably in December.
Have you received any expressions of interest so far from potential buyers or leasers?
Yeah, well, with respect to the city properties.
Yes.
Yeah, I mean, we do get occasional request for information over the transom, which we're sort of assembling. Obviously, this is going to be a formal process administered by EDC, and once that formal process starts, it will need to be done in strict accordance with the Public Authorities Law. But I do think that that there's significantly more interest in J Street specifically than there had been previously, and we've also had a few inquiries about a couple of the other properties. So, yeah, we. Okay. Anybody else?
Jeff, anything else?
No, I don't think so.
Anything? So then a motion, please, to adjourn the Finance Committee
Move.
meeting?
Second.
Second, please. All in favor? Thank you very much.